All right, we're going to talk today about accounting for income taxes. And this is a subject. The first thing we need to talk about is that accounting for income taxes for financial accounting purposes is very different than the income taxes that we do in federal tax class. So there's a different um, emphasis in these sorts of things, and we hope that over a long period of time the numbers, the cumulative numbers would come up approximately the same. But on any individual year, they're going to come up quite a bit different, and we're going to show you how to handle this for financial accounting purposes in this chapter that we're talking about today. So the first thing that you need to be aware of is there are a couple of terms that you're going to run into, and one is book income versus taxable income. Now, book income is just exactly what you think it sounds like. It's what is on your books for financial accounting purposes. There's no tricks or anything like that. It just is what it is. And then taxable income is what you would report on your income tax return. And so there's going to be differences there. Now, some of those differences will be permanent and some of those differences will be temporary. And we'll talk about those in just a minute. But it's important to understand that those are different. Well, why are they different? One of the things that we have to remember is that when is what are they trying to prevent, right? In income tax, the government wants to make sure that you pay enough tax, you pay your share of the correct tax. They really don't want you to pay more than what you're legally obligated to pay, but they want to make sure that you pay everything that you are supposed to pay. And so the prevention strategy is on preventing understating income. Whereas in financial accounting, we have the other situation where we're actually trying to prevent making the company look better than it actually is. And so we want to prevent you from overstating or misleading investors to thinking that things are better than they actually are, investors and creditors for that matter, better than they actually are. And so you have this difference in emphasis between what are you trying to prevent. And so the rules on how you report these things become different. So, like in financial accounting, we take a conservative approach. And so we don't book any contingent revenue until we actually have it in hand. On the other hand, we expense or we recognize liabilities as they occur. For tax purposes, on the other hand, in addition to the prevention of understating your income, is also a concept of wherewithal to pay. So, like when we receive revenues, we report that as taxable income, even if we haven't earned that, unless it's truly a deposit. But if it's a unearned revenue, like in the case of rent, first and last month rent. Well, first month makes sense. We'll charge it what it is. But last month rent may occur years and years from now. But we will have to record that as income when we receive it, even though we may not accrue that income and recognize it for financial purposes until years later. But the government wants us to pay tax now, partially to prevent us from understating it, but also because we have the money now. And so we try to tie paying taxes with when we have the money in this country, although there's a few times we don't, but that's what we generally try to do. And so that creates some differences in emphasis. The same with warranties and bad debt liabilities. In financial accounting, we want to prevent looking better than we are, so we accrue those liabilities at the point of sale. And whereas in tax accounting, the fear is that you would overstate those liabilities if you accrued them, thus delaying your tax payment. And so we have to recognize those liabilities, either a bad debt expense or a warranty expense, when we actually pay for them, or not receive the money that we've already booked as income. And so it's just a difference in emphasis that we're looking at, and this creates differences in numbers. And so we have to account for those differences, and that's one of the things we talked about. Well, we've already talked about these differences. So differences are categorized into two different areas. The first is permanent differences. And if you would look at Exhibit 17-1 in your book, and that's on page 993, they give you a list of about 8 permanent differences. And these are things like municipal bond interest. Well, if we receive municipal bond interest, we never pay tax on that. But we would certainly want to report that income to our investors and our creditors, because that's an important source, that may be an important source of income for us. Also, another type of permanent difference would be life insurance proceeds. Companies often insure what's called key members of the executive team, either an important salesperson or important designer, creator, something like that, an important president, CFO, those sorts of people. They often take out insurance policies so that the company can continue on and go out and have some money to find somebody new to take that person's place. And so if you've taken tax, you know that life insurance proceeds are not taxable in that case, because there is an insurable interest there. And so that income, although important to the company and shareholders and creditors would want to know about it, is not taxable, and the government just forgoes tax forever on that. Likewise, on that same thing, any expenses that are involved with municipal bond income would not be deductible, but they certainly are expenses that shareholders and creditors would be interested in us recording. So those are permanent differences. Also, things like fines. Certainly we would report a fine as an expense, but let's say, if you remember back, probably most of you are too young now, but Domino's used to have a 30-minute guarantee on their delivery. And eventually the government made them not do that anymore, because too many of their delivery drivers were getting speeding tickets and causing accidents and other sorts of things, trying to hurry to make that 30-minute delivery time frame. Well, if you paid for the fine, that would, if you were allowed to deduct that from your taxes, that would be subsidizing a fine, and that would be against public policy. So we don't want to take a deduction on something that is against public policy. So any fines the fine has to be by a governmental agency, like if a pro athlete was fined by their league for various conduct, that's not the fines that we're talking about here. We're talking about fines to the EPA, to the Department of Justice, those sorts of fines that are important here. And so those are permanent differences that we have, and so those will never be taxed, or they will never be expensed. On the other hand, we have some temporary differences, which we've already alluded to: warranty expense, bad debt expense. We recognize those up front for our financial accounting, but we only recognize those as they occur in our tax accounting. Likewise, we have revenue differences that are temporary in nature, such as the rent we received or interest paid in advance. We have to recognize that as income when we actually get it, rather than when it's actually earned for tax purposes. But for financial purposes, that's becomes an unearned revenue, and so is actually a liability on our books, whereas it's income on our tax accounts. So those are temporary differences, and you can see a list of those on Exhibit 17-4, which is on page 998 of your book. Now, both of these differences, both permanent and temporary differences, can go either way. They can increase taxes or they can decrease taxes. Let's take the example of a temporary difference of depreciation. For financial accounting, we try to match the depreciation schedule and recognize the expense, trying to do it along the lines that the asset expires over time. So most of the time in financial accounting, we're going to use straight line depreciation for the life of the asset. For tax accounting, however, they have what's called MACRs, and even now we have this we have bonus depreciation where you're allowed to write off 100% in the first year. So let's take something like a car, or car is probably not a good example because of the limitations on tax, but let's take a piece of equipment. We expect that to last 7 years for tax purposes. And for financial accounting purposes, let's say it lasts the same over 7 years. So we would end up taking approximately 16% a year on straight line depreciation. But with the current accelerated depreciation, we would take 100% depreciation the first year for tax purposes, and then no more depreciation from then on. Well, that's going to create a difference between the book income and the tax income. And so that's how that works. Now, what we end up doing for our tax expense, how we end up handling that is we take the book income and we subtract or add any permanent differences that we might have, and then we multiply that times the statutory tax rate. Now, for all intents and purposes in this country, corporations have pretty much a flat tax, even though technically it's graduated. It's pretty much a flat tax because the graduations are so steep. You get to the maximum income number at about $100,000. So basically today it's about 21%. Is what corporate taxes are at the federal level, and then add another 4% or so at the state level on average. And so a good number to use is about 25%. So you just basically take your book income, subtract any permanent difference, and that will give you your eventually taxable income, and you multiply that times the 25%, and that will give you your tax expense for book purposes. Now, our problems that we have in the book, they will use various tax rates and that sort of thing over time. The 21% rate is not that old. We used to be at 35%, and then you add another 5%, give you 40% with the state tax. That made a good round number to use. So you'll see a lot of that number, 40%, in some of the problems that your book has. But that's why, because the 21% rate is not that old. So anyway, that's just an introduction to permanent and temporary differences. And then I'm going to follow up with a few of these problems after this lecture, which is just about over. And what I am going to do, I didn't mention this in the intro video, I am going to break down each problem will be its own separate video, so you don't have to go searching if you want to look at one of them again to see what I did where. So that'll be available to you. But so I will see you, or probably won't see me actually, on the problem videos. You'll just see my handwriting on the piece of paper. But so we'll work a few of those problems and go from there. So good luck on your work, and we'll see you next time.